Hi everyone, I'm Nupur from Ionic Wealth, and we're here today to talk about the union budget and what it means. We're not really looking at just the headlines and the immediate knee-jerk news reactions. We are also looking at the budget from the vantage point of various stakeholders. With me today to discuss what this budget could mean for you, I have Shobit Mathur, who is our co-founder at Ionic Wealth. I also have Dharmendra Jain, or DJ as you like to call him, and Ankita Pathak, who is our macroeconomic strategist. And we are going to be looking at various aspects of how this budget translates into your portfolios. To begin with, I think one of the things that comes to mind is what really has changed in the budget versus what has continued from the past few years. And Ankita, I'll probably ask you this in terms of policy. What do you think are the big directional shifts that the government is indicating through this?
Sure, Nupur. I think one thing that we want from fiscal policy of emerging market economies is policy continuity. That does mean that foreign investors are more comfortable, domestic businesses are more comfortable, and in that context, the policy continuity is maintained. So maybe there are not too many moonshots that have been made in this budget, but that's a good thing. And especially more and more policy announcements are now coming before or after the budget. So you've already had, your GST reforms that have happened. You've had your FMCG taxes that were there that have been already been out. So in that sense, budget day today was about the math, the credibility, and some piecemeal reforms which directionally define India. In terms of two themes that stood out for me, one, for the first time, the defense budget as a percentage of capex is coming to close to 17 odd percent. So there is a clear directional shift towards defense. Second, again, from a very global landscape, India has this unique opportunity of tapping into certain exports, and India has predominantly be a low value add export economy. Now we're shifting it to a high value add export economy. Essentially, that means you can import for cheaper, add value, enjoy higher margins on your exports, and that helps the country. So in that direction, I think bunch of steps in electronic devices, telecom manufacturing, where export numbers are already clocking 25% plus after the US China. I think we've chosen to double down on our winners in exports. Again, that's a good thing to start with.
Okay. And if I may move the lens a little bit to DJ, since we've seen some bit of a knee-jerk reaction in the capital markets today, what do you think are some of the expectations that maybe were missed out in this budget?
I think one key thing which the market players were looking forward to was the tax impact from the FPI or from the private equity capital which India continues to draw a lot. I think recently there was some tax which was put on private equity, and the market was really looking forward to some clarification to come on that account. Primarily at a time when the rupee has also depreciated a lot. We all know that the FPIs have been a regular seller in our market. Some rationalization there or some announcement there would have cleared a lot of air. So that I think market would have expected something which was completely silent. Otherwise, I think what Ankita mentioned is absolutely right, that certain segment of the market where we have to add value, I think a lot more customs or the import duties have been rationalized or reduced to add value in India and then again export back. More particularly, we know that the tariff has been the topic for quite some time, and anything related to that on how we are preparing ourselves for any kind of a impact coming in, because we are yet to sign a deal with US markets. So something on those lines also, if market would have given some indication or some direction, the finance minister would have given some indication, would have led to little bit of clarity. But overall, I think a neutral budget, no major disappointment. At the margin, they have rationalized many of the areas, which I'm sure we'll cover it through the discussion.
In fact, if I can add there, I think many of the investors when we were talking to were talking about the fact that market hadn't done much last almost 18 months now, and there were some expectations around maybe some cuts on either STT or maybe long term, short term capital gains in some form or manner to just give a little bit of a boost. I think that didn't happen, so that maybe also put a little bit of dampener to the sentiment.
Right. Ankita, you mentioned a little bit about the credibility of the numbers and how the math is going to play out, especially in terms of capital formation. Could you highlight a little bit in terms of what are the key priorities, or maybe even the flip side? What are the main things that have been deprioritized from the government side?
So I think speaking of maths, I think, credibility is extremely important. There has been a phase, in Indian fiscal cycles where there was a lot of overpromise and underdelivery, and that kept the market shaky. This time around, on the flip side, I think the budget has been made with a very, very conservative lens. Market was okay for a nominal GDP of about 10.5%. Finance minister has herself assumed about 10%. So the chances of slippages are fairly reduced as far as the denominator of your fiscal is concerned. Similarly, your capex is going, at 12.2 lakh crores. I think that's a good quality expenditure that is coming in, and that's a growth of about 11.5%. Albeit it was cut down in FY26, but still a decent growth that we are seeing there. Onto the revenue side, again, there was an income tax shortfall this year, about 1.3 lakh crores. It is well recognized in the budget document, so that I think it's a good, credible sign. Some part of that money has been made by higher RBI dividend, totaling up to 3 lakh crores. But again, for FY27, they have not assumed some big growth numbers as far as this revenue part of the side is concerned. And in fact, the GST expectation from FY27 are minus 2.5%, which is fair because you're having a lower nominal GDP growth, you're having, the whole GST rationalization going on. So if there is a fiscal drawback, that has been very well acknowledged in the budget math. So I would say the budget, if at all, is on the conservative side. It is not erring on, being over optimistic. And that is good because it leaves room for surprises in the second half of FY27. If RBI dividend is higher than what is expected, if small savings are higher than 75,000 odd crore, which is fairly possible, if, inflation makes a comeback and you're able to clock higher than 10% GDP, I think in second half of FY27, a room for positive surprise is left. So good, credible maths, as I would like to put it out.
In fact, to add to that credibility, they spoke about controlling the deficit number below 4.5, and they eventually end up with printing 4.4. So I think the credibility is only getting strengthened by they sticking to what they said last year. So people can assume that this should also follow through in the following years.
Okay. One of the things which I hinted at the beginning is that we at Ionic Wealth believe that the vantage point from which you look at various announcements is important. And I think this budget has also, the way that it has been presented, also looks at different perspectives of different cohorts. So maybe Shobit, I can ask you this, that when you looked at overall what the announcement was and what the policy was, would you consider it a budget which is more geared towards capital building or more towards entrepreneurship or more towards, say, talent or services side of things?
I'll build on what Ankita earlier said. I think previous budgets had already done a lot of work for new set of private investments to happen, manufacturing to be picked up. So I think a large part of what entrepreneurs would have wanted had already got taken care of in a big way. I think this budget is a little more focused towards specifically people who are professionals working in organizations, because I look at this budget as a budget where they have tried to rationalize a lot of commonsensical questions that otherwise were asked of, that why are things in a particular way, and I'll give some examples for that. And also I think for a lot of offshore NRI slash individual investors who are looking to invest back into India, given India being one of the attractive destination, I think it is targeted to solve for problems of those. So when I talk about rationalization, for example, the government has come out with a very simplistic set of things. For example, there was this whole tax which used to be there on buybacks, and there were a lot of IT companies which were talking about buybacks, but unfortunately nobody would have participated in those because you were being asked to pay full rate of tax. Otherwise you could have sold the same security on the exchange and put long-term capital gains on it. I think they just rationalized it to say, okay, if you are going to be participating in that buyback, you no longer need to pay that higher rate of tax. You can practically just do with long-term capital gain or short-term capital gain, as the case may be. Similarly, I think we did speak about a little bit of market sentiment because of what STT has, I think, also done.
Yeah.
I think this budget is trying to talk about making people focus more away from being more short-term speculators to now being a little more long-term savers. And I think these kind of rationalization steps are important as we are building towards next phase. So I think in that sense, this budget is more targeted to those set of segments.
Yeah, look, if I may just add, I think there's a lot of focus on skill development. So there is, and this is across the income pyramid. So there is a skill development focus for SMEs. There is a skill development focus on, global talent returning to India, how to make, life easier for them. I mean, all that we talk about India's demographic dividend is really not a dividend if you don't have enough jobs. And there is that underlying theme of whether in manufacturing or in services wanting to create more jobs. If that dream materializes, I think there is a good policy long-term tailwind there.
Okay. Taking on from also what Shobit said in terms of there are a lot of practical or, implementable changes which have happened in the budget. TJ, could you throw a little light in terms of an investor who's looking at their portfolio right now? Are there any real impacts on certain types of instruments or certain types of platforms that may come into the picture?
Yeah, so this increment of for the STT on the options and futures for the stock market, which Shobit rightly said that the focus is to move from speculation activity to more savers, that might create some impact on some of these products which were built on the arbitrage opportunities where they used to use futures and options a lot more. So maybe arbitrage fund, I think, can have an impact on an annualized basis starting from April, because all of these things will have to be passed as finance bill and will get implemented from April 26 onwards. The impact might be to the tune of 20 to 25 basis points. Similarly, there are categories like AIF long shorts where the activity or the transaction volumes would have been much higher. Some of these activities where people used to trade on their proprietary books in terms of the HFTs or MFTs, those things also might take a bit of knock on their profitability, and that's what an impact on the stock market also, as some of these market players or market infrastructure players as we call them saw the impact in terms of the cut in their stock prices also. So some of these things I think if you're an investor there, the future returns might be a bit lower. Apart from that, I don't think that the finance ministry have tinkered in any of the tax rates, so the life continues to be as is. Gold and silver, of course, with the huge performance on the back of the last 2 years, people were expecting that India is any which is a large importer of gold, so there might be some duties etc. which might come in, or government might think about taxing in some way the gold and silver ETFs, or their tax rates might increase. That didn't happen. So I do think that the investors into gold and silver may continue to have a sigh of relief that yes, the one clarification which I think the finance ministry did give on the SGBs, which is sovereign gold bonds, that anything if you have purchased outside the primary subscription, and if you have purchased in the secondary market, there I think there was a bit of a clarification was missing. I guess that has been clarified now, that if you have invested from the secondary market, even if you are holding it till maturity, you have to pay a capital gain tax now and your tax is not exempt. So to that extent, anybody who would have bought the SGBs over the last couple of years, and if I am assuming that it has been clarified and not anything to do with grandfathering or something, I think those investors might have to adjust their exempted tax to now a 12.5% or maybe higher tax the time of maturity. So that these are some of the small implications which might have come in the budget.
Okay. So I think we said multiple times that 2025 was the year of asset allocation, but we did see some of the assets, specifically like equity, going through a tough time. I just want to get a sense from you, what do you think is going to matter in the year going forward?
If I were to look at it from investor lens, and I think most people in India were traditionally more savers and more fixed income oriented investors. And I think post 2020, when markets started to really take steam, a lot of investor allocations have moved significantly away from fixed income, very, very heavily into equities. I think all of them would have had a fantastic ride all the way till last year or so. And last year has been the year where people started to face that challenge. And I think in that sense, at least for us as people who have been advising clients on their portfolios, asset allocation obviously has helped navigate the previous year. In fact, it's sort of more than compensated, because allocations that were suggested into gold or silver or other asset classes, like diversification into global assets, have naturally overcompensated beyond what kind of returns that Indian markets gave. And I think the following year should be no different, because each market is going to go through cycles. Ankita spoke about the kind of push that the government is doing, the kind of nominal growth rates that we are expecting. I think equity market returns will have to be looked at in light of what one is looking at it from a nominal growth standpoint. And that also means that it cannot be the only asset class that investors can bet on to generate them disproportionate returns from their portfolio. So I would continue to believe, and I think as a house, our philosophy has always been to look at it as a multi-asset portfolio, depending on profiles. Look at domestic equities, look at offshore equities, look at commodities as an allocation, and of course, looked at fixed income to more balance out the rest. So I would say the following year will be no different, and I think the budget hasn't given us any reason to think differently than what we would have thought before. And of course,
Yeah, no, just to add to
to that.
Shobit, I think asset allocation is an all-weather strategy. So single policy or budget announcement really doesn't change it. Even with that budget lens, if you want to break down, let's say, four big asset classes, equity for sure, you've had, few pushes in, let's say, chemicals, pharma, buybacks make, IT sector. But these are very short-term impulses. The market will eventually award earnings, and it is purely that fundamentals that investors should scout for. So there, that remains true for domestic equities, that we do want earnings growth to come back. Onto the debt, which is the second most followed asset class, probably, is that, see, debt markets were probably expecting lower gross market borrowing, because expectation was that from small savings they'll be able to fund a bit of the deficit. That is exactly not what FM has penned down. But net borrowing numbers at about 11.5, 11.7 lakh crores are all more or less okay. So I do think that the India 10-year yield, which has been under pressure because of the global cues, continues to face some of that pressure. But given that this budget was not very, very expansionary, the RBI, the monetary policy, still has space to act. So while fiscal has done, its bit, I think it is MPC that will be extremely important, and if they're able to deliver more cut, inject more liquidity, I think somewhere your bonds will get some help from there. So now the baton is purely with the monetary. The fiscal is behind us and was not really the best kind of borrowing number that markets were at least expecting. On to the commodities. Now, obviously, Indian prices, we are a price taker of what happens in global markets. It's a separate conversation altogether, but I do think one part where budget could have helped or not helped, as DJ said, was one, tweaking with the rates that has not happened, import duty has not gone up. Um, and finally, the budget doesn't look too bad for USD INR also, which is something that can affect domestic prices of commodities. So I would say fairly neutral on commodities. It remains a very, very global asset class to be in.
One thing which probably we didn't expect the government to directly address was global geopolitics and what is happening and how we can protect our economy from that. But if we talk about investments into global assets, do you see any takeaways that can help from the budget?
I think, in fact, on the reverse, they have done what they could do to get foreign investors to look at Indian markets more favorably, and they have, of course, relaxed the amount of money individual investors can invest into India. So the limit used to be 5% per individual into a particular stock, that has become 10%. So automatically, especially more for mid and small cap companies where sometimes some individuals may have larger exposures, it allows for more investments to happen. So in some form or manner, I think adding on to what DJ had earlier said about they realizing that on a instrument like sovereign gold bond, gold prices have suddenly rocketed. People might, be booking profits, and that profit may not result into equivalent amount of tax benefit for the government, and they decided to, make it clear that if you sell and if you're not a primary buyer of that bond, you will pay tax. I think in similar manner on all other type of aspects, the government would have realized that this is the point of time when they need to get offshore investors, especially NRIs who otherwise will have a soft corner for investing into India, to give them some more reason to actually incrementally look at investing. And I think it's the best way for them to really hedge themselves, especially in a year where you have not seen FIs participating at all. So this is like giving one more segue to another set of large potential investors to say, we welcome you with both hands and you can possibly participate much more into Indian equities. And I think that's the more important part from a broader macro point of view. Of course, for Indian investors looking to invest outside, that's I think something that Ankita should possibly talk more about.
Of course, while inbound has been lubricated further, outbound at least has not seen any, bad treatment, if I can put it that way, right? So LRS limits, not for investments, of course, education, medical, it has been brought down to 2%. So that's policy, positive step in that direction as far as outbound capital is concerned. Within GIFT City, the companies that are setting up, the tax holiday period for them have been extended to 20 years out of 25 years, which used to be 10 years out of 15 years. So again, policy wise, it is, a push in the right direction. I think India is still far from, of course, being a, no capital control economy, but at least the budget is not conservative. On the borderline, I would say the budget remains progressive. And as Shobit said at the start, that, asset allocation remains all weather. So if global equities form a part of, your asset allocation, I think keeping status quo into global investments, which is a category that has really bloomed in 2025, is a step in the right direction to begin with.
Okay.
Shobit used to keep saying that, as like Indian consumers, especially in the HNI category, your dollar expenses are much more than, what your importer inflation basket says about 15%. We buy, our iPhones, we buy our gadgets, travel abroad. So maybe your 65% expense is still made in dollar, which is why global investments make sense. And this budget then reducing the TCS to 2%, postal import tax on, commodities that you get from abroad is also been reduced significantly. So there is a bit of a direct, you can probably spend more in dollar going by the
So,
complexion of the
in
budget.
general, maybe a good idea from a personal perspective to be more easier to spend abroad now.
Yes. And if you're spending more, you probably should invest more to plan it right.
Great. I think one thing which the budget didn't do is to change too much on the personal taxation. But if I were to ask DJ, what is one big signal that you take away from this union budget as an individual?
I think most of the things the government has now started doing outside the budget only. So we can't expect every year to have dole outs, because at the end you have to also manage the fisc very well, and that's what the government has kind of delivered fabulously. I think one thing is, if I have to look at from the investment point of view, uh, the fact that what Shobit just said, that the NRIs now can invest from 10% to now own 24% of a company without RBI approval, and the individual can invest from 5% to now 10%. It's a good way of counterbalancing the FPI outflows. I think India continues to be a strong growth market. Yes, of course, a couple of years our nominal GDP growth has been disappointing, and that's where the factoring in of 10% as a nominal GDP growth this year can lead to some performance again or some stock performance again coming back. But there are too many layers or things which further determine the overall equity performance for a particular geography. So I do think that probably this counterbalancing probably can be benefited can be benefiting the companies, can benefit the continuous outflow which we have seen from the FPIs, and the domestic investors and savers have kind of negated that outflow by keeping it very strong. So if NRIs start to contribute, and some of the aspects again have been made easier for NRIs, for example, if they are selling their immovable properties in India, they do not have to now deduct TDS or deposit tax. The domestic resident can deduct TDS and can pay on their behalf. So some of these things I think they have taken care of and or would have heard of some of the recommendations of NRIs sitting outside.
I think Shobit also alluded to the fact that they're just very practical, like useful things which are going to be implemented as part of all of this.
I think one of the simplest things, all of us have heard people with that confusion about which is my financial year and which is my assessment year, and they just made it simplistic to say
All
it's
this
just a
tax
tax
year.
year. So very small, simple, additive changes which are more commonsensical, and I think those are also good things to make things easy for people who have to implement those taxation related issues in their own files.
So rationalization, as Shobit pointed out rightly, that I
Make
think
life easier.
a lot more things are getting rationalized now.
Okay. And Ankita, maybe this one's for you. If I, as an investor, did nothing after listening to today's budget analysis, what do you think? Am I on the right path or?
You're a fantastic investor. That's exactly what most nuanced people should do. I mean, and if you do like your whole investing model, I think fiscal policy is one small part of it. And globally, fiscal policy has always been a non-event. In India, obviously, budget day used to be something that used to be, extremely hyped. A lot of announcements used to be made. I think we are converging with rest of the world where budget is all about the math of the numbers and how was the year like and what you're going to do as a country. Consider it like a budgeting exercise for the country. The impact on asset classes is fairly limited, and if you did nothing, that's a great strategy, Nupur.
Okay.
But of course, if you tinker with certain aspects like taxes or where your focus of expenses is or are, that will also make a lot of difference. So budget to that extent where you are focusing as a government is also a very important thing to look at. So I would not say that it is not a non-event. It is something where the government is going to focus on. If you tinker too much on the taxation part, etc., so it does make a difference. So from the today's budget, I don't think that apart from the STT bit which would have impacted, or the SGB which will be taxed now, which people would have supposed that if I hold it till maturity would have been zero tax. I don't think that from the investors standpoint of view there was anything negative per se.
So sometimes it's also that they've not done anything that helps.
Yeah.
Policy continuity is a great thing to have.
Okay. On a concluding note, we've talked about the budget being important for the real economy. Shobit, could you maybe summarize for us what this means for portfolios?
No, I think we said that the government has continued what they said that they will do previous year, and it is demonstrated. What they said about discipline is again something that they have demonstrated. And I think as investors, one doesn't need to do anything different than what the government possibly is doing. So individually, our own budgets and our own finances need to be managed in the same manner, that people should continue to do the right set of activities, which they should continue in the form of asset allocation, in the form of discipline. And I think that is the best way to go forward and ensure that the portfolio is best optimized. So I'll stick to the government's stance and have everyone follow the same thing for their own portfolios.
No, of course. And I think Shobit makes a very interesting point, because while policy strategy is one part, now the baton is on the implementation and execution and timely execution of this. And I somehow feel beyond budget also 2026 will check, your execution capabilities more than the strategy capabilities per se. And far from home, those US tech giants have to prove and execute all the capex that they've taken upon their balance sheet, convert into revenue. And similarly, back home, our investors have to remain true to the asset allocation by executing things on time, because 2026 promises to be year which is likely to be volatile, where your behavioral biases kick in more often than not. So I think execution will remain extremely important for investors, and of course even for the government. The strategies made looks credible, looks good on the face of it, but it will all be about making those numbers, meeting those numbers, and being able to pass the numbers on ground in time.
Yeah. So we are looking at now a year of execution versus allocation.
That's it.
Great. Thank you so much, Shobit, Ankita, and DJ, for that interesting conversation and adding perspectives to what the union budget can mean for individuals. We also do note that the budget is not a one-day event, and there is a lot that happens over the year. And at Ionic Wealth, we always try to keep you updated with what's happening. So do follow our monthly strategy reports and make sure that your portfolios are always aligned towards the future.